What are key anti-money laundering, AML, regulations? Have you ever wondered how money laundering schemes operate and what is being done to combat them? Anti-money laundering regulations are essential legal frameworks designed to stop criminals from disguising illegally obtained money as legitimate funds. These regulations requiring financial institutions and certain non-financial sectors to detect, report, and prevent money laundering activities. From a cultural anthropology perspective, these regulations intersect with informal economies and cultural practices. They aim to disrupt illicit financial flows that can undermine social and economic structures. Let's break down some key regulations that play a significant role in this fight. First, there is Customer Due Diligence and Know Your Customer. Financial institutions must verify the identity of their clients and understand the nature of their activities. This helps identify suspicious behavior and prevents anonymous transactions that facilitate money laundering. Next, institutions are required to report suspicious transactions. They must monitor transactions and report any that seem unusual to the relevant authorities. This includes large cash deposits, rapid movement of funds, or transactions that do not align with a customer's known profile. Record-keeping requirements are also crucial. Entities must maintain detailed records of transactions and customer information for a specified period. This documentation supports investigations and audits by regulatory bodies. Risk assessment and management are vital components too. Organizations must assess the risk of money laundering associated with different customers, products, and geographic locations. They then apply appropriate controls to mitigate these risks. Another important regulation involves politically exposed persons. Special scrutiny is applied to individuals in prominent public positions, as they may be more vulnerable to corruption and money laundering. International cooperation and coordination are emphasized in these regulations. Countries and agencies must collaborate to track and intercept illicit financial flows that cross borders. Sanctions and asset freezing mechanisms are also part of the regulations. These allow authorities to freeze the assets of individuals or entities suspected of involvement in criminal activities, including terrorism financing. In practical terms, AML regulations extend beyond banks to sectors like the art market, real estate, and informal economic activities. Anthropologists study these areas as part of informal economies. These sectors can be exploited for laundering money due to less stringent oversight. For instance, the art market's lack of transparency has been identified as a vulnerability for money laundering. From an anthropological viewpoint, AML regulations can impact informal economies and entrepreneurial practices by imposing formal controls on transactions that were previously unregulated or culturally embedded. This can create tensions between enforcing global financial norms and local economic behaviors, sometimes leading to unintended social consequences. Overall, key anti-money laundering regulations aim to protect the integrity of financial systems and civil society by preventing the integration of illicit funds into the economy. However, the effectiveness of these regulations depends on careful implementation and coordination across jurisdictions and sectors.